The stock market is headed for an epic crash soon. This is not clickbait. There are several warning signs flashing danger ahead. Call us a party pooper, but we are not going to ignore the red flags. And we're not the only ones. Bank of America's chief investment strategist, Michael Hartnett, has been warning about a big collapse ahead for quite some time. He predicts the economy's eventual hard landing as early as in 2024 itself. Ted Oakley, the managing partner and founder of Oxbow Advisors, makes similar predictions. In a recent podcast, he said that the worst will be ahead of us here over the next 1 or 2 quarters. Market strategist Jon Wolfenbarger even goes one step ahead. He sees a big crash and a year-long recession ahead. Wolfenbarger says the market is highly vulnerable to failing to new bear market lows. He adds, most investors do not see this coming as they are being misled by the persistent strength of a handful mega-cap tech stocks. They have already forgotten how much those stocks fell in 2022. Funds manager Jeremy Grantham thinks the US stocks are heavily overvalued, a recession is coming, and AI is overhyped. Watching so far, if you are thinking we are just cherry-picking the naysayers, let us show you 6 indicators of impending market crash. Indicator 1. We have seen this movie before during the dot-com bubble. Mark Twain said, "History doesn't repeat itself, but it often rhymes." When it comes to the stock market's history, there is an eerie rhyme. Market watchers believe the stock market is reliving the dot-com tech bubble of the 90s. According to Michael Hartnett, markets are behaving as they have in the past bubbles. The first 4 weeks of January saw both bond yields and stock returns dancing to the same tune. Hartnett notes that this type of market behaviour is typically observed just after a recession, or in times of market bubbles similar to the dot-com era. Veteran investment strategist and president of Yardeni Research, Ed Yardeni, thinks the current stock market growth is fueled by hype around the tech sector, especially AI hype. For instance, look at the price behaviour of Nvidia. Since the launch of ChatGPT in November 2022, the stock price of the largest manufacturer of AI chips has gone up more than 250%. It reminds us of the parabolic growth of Cisco, which saw its stock price go up 8-fold between 1997 and 2000. Yardeni thinks, instead of a repeat of the inflationary 1970s or a replay of the productive-led boom of the 1920s, the current decade has the potential to play out like the tech-led stock market party of the 1990s. Indicator 2. The Buffett indicator signs danger ahead. The market is making new highs like there's no tomorrow. However, stock market history shows the markets don't keep up forever. Whenever overvaluation takes place, an eventual crash is never too far away. The more inflated the market, the harder the crash landing afterwards. So, how do we know the market is heated? Investing legend Warren Buffett gave a simple formula to gauge whether the market is undervalued, fairly valued, or overvalued at any point in time. The formula, called the Buffett indicator, is the ratio of the total US market capitalization and the value of the total US gross domestic product. The theoretical basis is that the market is overvalued whenever the stock market valuation is significantly high compared to the market value of economic output, that is the GDP. When the indicator crosses the value of 100, it means the stock market is highly priced compared to the real economy. According to the currentmarketvaluation.com, the value of the Buffett indicator as of January the 19th, 2024 is 185%. Currentmarketvaluation.com demonstrates that the current Buffett indicator ratio of 185% is approximately 51.54%, or about 1.7 standard deviations above the historical trend line. This suggests the stock market is extremely overvalued relative to GDP. The Buffett indicator has an enviable track record. Warren Buffett called this indicator probably the best single measure of where valuation stands at any given moment. Interestingly, the Buffett indicator peaked in 1999 and 2007, followed by a severe stock market crash. Are we on the brink of another one? We think yes. Indicator 3. Investors' euphoria. Legendary investor Sir John Templeton once said, "The 4 most dangerous words in investing are, 'This time it's different.' No matter how hot the market is, you will always find some investors saying 'this time it's different.' forgetting the past instances of epic crashes in which stock lost 70 to 90% of their value. Many investors expect the market to keep moving to the moon. Bank of America's Bull and Bear indicator is a reliable measure of investor sentiment. It's currently flashing a 2.5-year high value of 7.2, indicating extreme optimism and borderline euphoria. A recent note by the Bank of America shows only 5% of investors are expecting a hard landing of the economy, while 75% believe there will only be a soft landing. The remaining 20% expect the party to continue. Also, there is an expectation that the Fed will eventually cut rates to give a boost to the economy and asset prices. However, as CNBC reports, the central bank will proceed carefully with interest rate cuts this year. Also, the Fed is likely to move at a considerably slower pace than the market expects. Additionally, as the inflation rate is persistently above 3%, the Fed is likely to delay rate cuts until inflation comes under the 2% target rate. So, what do you think about the possible direction of the monetary policy? Do let us know in the comments section. Indicator 4. It's mainly a tech-driven rally. On the surface, the market looks strong and invincible, but the devil is in the detail. Looking deeper, it's basically a tech-driven rally riding the AI hype without much broader market participation. The so-called Magnificent 7 technology stocks have led the Nasdaq 100 index's 54% surge in 2023. These 7 stocks are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia and Tesla. If we look at January's S&P 500 returns, these Magnificent 7 accounts for 45% of the index's growth. Now, if we exclude Tesla, which saw a sharp drop in its stock price this year, the remaining 6 stocks explain about 71% of the S&P 500's January growth. The combined market value of these 7 tech giants has risen to a whopping $12.5 trillion. This equals the combined GDP of 11 major cities, including New York, Tokyo, London, Los Angeles, Paris, Seoul, Chicago, San Francisco, Osaka, Dallas and Shanghai. According to billionaire investor and Double Line Capital CEO Jeffrey Gundlach, this happened in 2008, 2009 as well. The blue chip stuff gets very overvalued, so people start to relax their value standards, if you will, and they start moving down into junkier things. Experts think this rush into technology stocks resembles the stock market bubble of 1999. Indicator 5. Ballooning consumer debt. For years, experts have been warning about the exploding consumer debts in the US. The total US household grew to a whopping $17.5 trillion in the fourth quarter of 2023, and there is no sign of consumer debt stabilizing anytime soon. According to the latest Federal Reserve data released on February 6, 2024, US household debt grew by a record $212 billion in the fourth quarter of 2023. At the same time, credit card balances rose by $50 billion to hit a record $1.13 trillion. Mortgage balances too swelled by $112 billion to reach $12.25 trillion. Debt holders are also carrying their debt for longer periods. According to Wilbert Vanderklau, economic research advisor at the New York Fed, the rising debt level signals increased financial stress, especially among younger and lower-income households. Inflation and higher interest rates are contributing to rising credit card debt, making more Americans struggle to pay down their credit card balances. When debt is unmanageable, the slightest sign of recession can trigger mass defaults and more economic pains. This is how recessions snowball into depressions. The US consumer debt bomb, which will eventually explode, can lead to a horrifying market crash. Indicator 6. Brewing geopolitical tension. If all these were not enough, the rising geopolitical tension are creating the perfect background for an economic meltdown. Studies show a strong correlation between periods of global peace and economic prosperity. Unfortunately, this is not one of those times. The Russian-Ukraine war is going to enter its 3rd year. Also, we do not have any reason to believe the Israeli-Palestine conflict is going to end anytime soon. Plus, the rapid rise of China and its growing divergence with the West will have economic and financial repercussions. For instance, if the ongoing US-China trade war intensifies, large US firms are likely to take a big hit. Referring to the current geopolitical situation, Jeremy Grantham thinks the current backdrop is scary as hell and in which bad things can happen. This geopolitical backdrop is especially worrying when assets are at record highs, he adds. The ace investor, often called the bubble guru, recommends investors ditch overvalued US stocks. His advice is to seek out undervalued assets in emerging markets like Japan, depressed sectors like natural resources, and growing areas like climate change solutions. Warren Buffett has time and again advised being careful when others are greedy. As we talked about 6 warning signs, this is probably a good time to be careful while many investors are still euphoric. Thank you for watching this video. See you soon with another exciting video on money and investment.